Ladies and gentlemen, welcome. I'm speaking into this microphone because, just so as you know, this is being recorded for CISI TV. So if anyone doesn't want to be seen with the person you're sitting beside, now is the time to move. My name is George Littlejohn from the CISI, and I'm frankly spoiling my own party here because this is the first time we've had an all-female panel in the 21-year history of the Institute. I'm simply here to introduce Harriet Lloyd-Dehler, who has very kindly offered, is that right? Something like that. And will do a great job chairing this panel. Harriet is with Charles Stanley, and before that was with the Institute for 3 years. But I'm here to wish a happy birthday to, I guess, the main star of this event, not Sophie Robson, everyone here is a star, but the CSFI, which this year is 20 years old. The Centre for the Study of Financial Innovation is a terrific think tank, which our Institute supports in a modest way. It's supported by most of the big banks, accounting firms, law firms, and so on in London, a great institution. Sophie here can tell you all about it afterwards, and Dr. Andrew Hilton, who set it up and runs it, is somewhere in the audience, I think. Anyway, happy birthday, CSFI, and Harriet. Welcome all.
Good evening, everyone, and welcome to this event, Generation Y, the Modern World of Personal Finance. The CISI is the premier professional body for the investment and securities industry, for those of you that don't know the Institute. To introduce myself, George has already kindly done it. I work at Charles Stanley, we're a stockbroking firm, and I head up our Learning and Development Department, so I work very closely with the Institute in terms of the qualifications and CPD. Alex Cannon, who has joined us as well, he's at the CISI. He's the Senior Client Relationship Manager, and if you did have any questions afterwards to discuss about qualifications and CPD, please find him. Before I begin, I'd like to thank Cairns Business School for letting us host this evening, and just to remind people to switch off their mobile phones. We have 3 fantastic speakers this evening who are going to give their views on this topic. Each speaker will have around 5 minutes, which will then allow us good time for Q&A, so please make sure you can think of some good questions. After the event, we'd then like to invite you for some drinks and nibbles. So firstly, I'd like to introduce Sophie Robson. Sophie is the author of the recent review that you've all got a copy on your seat. And this was a report on young people and personal finance. And Sophie is also a regular commentator on issues surrounding young people and financial services. We're also lucky to have a couple of those people who were part of this study here this evening. She has been working for the CSFI since graduating with a BA in English Lit from Newcastle University. Thank you, Sophie.
Well, I'm going to talk about my report and sort of introduce it really before Steph and Jeanette get talking. Is the microphone okay? Okay. So, if we start off just talking about the landscape of it, really, a moment. Well, at the moment, youth unemployment in the UK stands at 22%, and it's actually the third highest rate of unemployment after Greece and Spain in the G8 countries. House prices are out of reach of most people. The average age of buying a house is 38 at the moment. But government and private organisations are working at the moment to sort of reverse this and do something about getting financial literacy into schools. There's My Bank, which is a sort of practical organisation which works with school children and does workshops. And there's PFEG, which works with schools and school children directly, sort of teaching them about the theoretical things. And at the moment, the all-party parliamentary group on financial education for young people has produced a 150-page report for the Department for Education, which is looking at getting financial education, making it compulsory in schools. Okay, but on with the report. Well, the report was it was based on a survey of 440 young people aged between 18 and 25, and it also included 16 first-hand accounts from young people also aged between 18 and 25. And it looked at their attitudes towards debt, savings, pensions, technology, so a wide range of sort of aspects of the financial services industry. Banking and financial education was a quite important aspect of that. Responses came from around the UK and were collected from schools and sixth forms, further education colleges, universities, and those in their first jobs, and also youth organisations, so sort of YouthNet and organisations like that. It looked at, as I said, different aspects. So the first thing we looked at was pensions, and there were some quite striking results from the report. First of all, it sort of highlighted the lack of understanding and confusion that exists around pensions. So 30% of respondents were contributing to a pension. However, 40% of them did not actually know what type of pension they were contributing to, even though they're possibly contributing to not a defined benefit but defined contribution. There was very little knowledge on how a pension scheme actually worked. Not many people knew what an annuity was. And the general sort of conclusion was that it was inflexible. There was a lack of certainty in the future of it. So, I mean, as I said, the final salary pension schemes all but died. And a lot of people don't really trust where they're going to put their money after this. A foreign national also she was concerned about the challenges of paying into a pension, because if she ever wants to move back to her own country, she wasn't sure if she'd be able to do that and how she'd go about doing that. There are steps that are being made to sort of counteract this. So auto-enrolment has just come into place, which kind of guarantees a small sum of money will sort of get paid from your salary into a pension every month. Obviously, it's probably not going to be enough. And then also the sort of flat rate payment of £144 rising with inflation is going to take place from 2017. Remains to be seen whether or not these will have much effect though. Do you know, sorry. Well, just to move on to the next thing, it was sort of choosing a bank and choosing a bank account. Thanks. And there were some quite striking things that happened here. So 50% of all young people chose the same bank account as their parents. And then 70% of students were kind of a little bit dismayed. They didn't like the way that they were kind of bombarded with introductory offers. So when I started at university, I was kind of offered a free sort of like student rail card and things like that, which is all great. But I was also offered things like free CDs and things like that. And 70% of students said that they would actually prefer to receive more sort of advice and support with budgeting. And then they also found language and jargon used by the financial services industry quite difficult to understand. Another report by MRM discovered that young people were more likely to understand a foreign language than basic financial jargon, which is probably quite startling given the sort of British people and all that. Next slide. Well, we also looked at savings and investments, so that also included things like home ownership and et cetera. Now, 3/4 of all respondents did have £500 in savings at least, which is probably in line with the national average. Nearly 2/3 had over £1,000 in savings. Women had fewer savings than men. It's an important sort of point. It also includes bonds, so it includes all aspects of kind of savings. Men were also more likely to diversify their savings than women, and they also kind of took more risks with their money in general. Women were more likely in general to go for traditional savings vehicles, like a current savings account or a current account or a savings account. However, most people were kind of optimistic about owning a home. I think about 40% expected to be owning a house by the time they were 30, which is probably quite unlikely, especially if they live in London. And then debts. We kind of found two different tranches here. So on the one hand, they were quite risk averse, but on the other hand, they kind of recognised that it was a growing problem among young people in general. It's kind of being normalised, the idea of debt. So sort of they were worried about debt, but they hadn't really accumulated much of their own debt because they haven't really been able to take advantage of saving, like credit and sort of debt, and they don't have mortgages in general. But 79% of them did have student debt. Just 3% had ever borrowed from a payday lender, such as Wonga. As for credit and store cards, about 3/4 or 2/3 paid off the amount in full at the end of every month, which is quite positive, I think. However, they were sort of able to make distinctions between student debt and other types of debt. So I kind of differentiated between commercial and higher interest. So student loan sort of debts, that doesn't show up on a credit file. But they were sort of unaware about how student loans worked. So many of them sort of said that before they started at university, they hadn't known that interest was payable on it, and they didn't really have much idea about how it worked, which I think is quite alarming. I think that before you start university, you should kind of know about the payment system and the amount of debt that you're going to be paying into. Lastly, financial education and standards at schools. So more than 2/3 had not received any financial education at school, and it didn't seem to matter whether they were male, female, went to a private school or a state school, graduates, non-graduates. However, 80% did say that they were interested in learning more about personal finance. And to conclude, I think it would be interesting to see, as I mentioned at the beginning of my talk, the all-party parliamentary group is currently deliberating about getting it compulsory in schools. So watch this space, I think, really, where that stands. So I think possibly pass back to Harriet. So
Thank you very much. Brilliant. Thank you very much. If you could all hold any of your questions that you might have for the end, we'll then do the Q&A session right at the end. I'd now like to introduce Stephanie Rochford. Stephanie joined CEN in 2009 and has worked in a variety of roles where finance meets social issues. She project manages Long Finance, an initiative established by the Zen Group and Gresham College to explore and encourage long-term thinking in the financial services community. The initiative began with the question, when would we know our financial system is working? And seeks to challenge a system that cannot provide today's 20-something-year-olds for a reliable financial retirement structure. The Long Finance hosts and promotes a series of events and research on this area to help create a better understanding for the future. Beyond Long Finance, Stephanie's work has ranged from improving performance for non-profit organisations via process and IT benchmarking to research and development of the online community platform. Stephanie holds a BA in English Literature and an MA in Contemporary American Literature, both from the University of Sheffield.
Thanks, Harriet, and thank you to CISI for asking me to speak this evening. So as Harriet mentioned, I've been asked to talk about Long Finance. So I'll say a little bit about that initiative and then hopefully try to tie it into some of the themes that Sophie's been discussing about the report that she wrote. But before I do that, I actually had some questions myself for this audience. So if you wouldn't mind just raising your hands, I wanted to know who here currently has a pension plan. That's a lot of you. Good, well done. I also wanted to ask how many people here born in 1991 or after know that they have nearly a 1 in 4 chance of living till they're 100? Was anyone here born after 1991? one man. Was it two? Okay. Okay, so you guys, what do you think the chances are that your pension's going to work over that time period and really be sufficient if you're going to be living to 100? Okay, it's just some food for thought, really. I think everyone here is obviously very aware of the fact that finance and financial decisions are very fundamentally linked to aspects of our everyday lives, so from the loans we take out as students to the pension plans that we pay into for our retirement. And while we can think about these in isolation, what they all fundamentally rely on is a financial system that works and that functions effectively over the long term. And really, this is the kind of thing that long finance is looking at. I think I should have prepared with Harriet as well, because she's already told you about some of the background. But so we were basically established in 2007 by Michael Manelli, who is one of the directors of ZN Group, which is a commercial think tank based in the city, and by Gresham College, which I'm sure a lot of you know is an institution founded by Sir Thomas Gresham at the end of the 16th century to provide free public lectures in the City of London. And our question is, when would we know our financial system is working? So we're hoping to improve society's use and understanding of finance over the long term. And really, it was established because it had become clear, I think, that financial thinking really needed to broaden and to look more widely at social, ethical and economic relationships of financial services in a very broad sense, but also to deepen and to look at some new frameworks and models that would help to develop a system that was more robust and to develop more robust financial approaches. So what we're really doing at Long Finance is trying to challenge the short-termism in the financial system that, for example, we don't think can provide today's 20-year-olds with a reliable retirement structure, for example. And we want to reframe that discussion into a much longer time frame of 100 years, which obviously is going to become more and more pertinent to the next generation, whose life expectancy is rapidly increasing. I think just to contextualise it, Long Finance was very much inspired by a foundation called the Long Now, which is based in San Francisco, and they're also trying to foster long-term thinking. They have an iconic project which is called the Clock of the Long Now, and it's a clock that is designed to last for 10,000 years. So it ticks once a year, it chimes once a century, and then the cuckoo comes out at the turn of every millennium. It's quite a nice idea, and they're actually building it right now in a mountain in Texas. That's actually under construction, and there's a prototype actually in the Science Museum. So, of course, 10,000 years, it's not really a framework that we can apply to financial services, and we're not trying to, but what we're trying to do is think about a system that is enduring over a significant period of time. We also wanted to try and see if we could create some sort of iconic project in the way that the Clock of the Long Now is an iconic symbol of the Foundation's concerns. So what we've come up with is something called the Eternal Coin, and the idea is that it's basically a coin that would never lose its value. And the reason I mention that is because the Eternal Coin is really at the heart of Long Finance, and it reflects one of our principal research themes, which is into the nature of money, how money is created, how value is created, and how it's stored over the long term. In 2010, we published a research report by Dr. Malcolm Cooper on the Eternal Coin and what it might have looked like through the ages, through history. And actually, at this stage, that paper really is the basis of this whole kind of thought experiment. What we would ultimately like, ideally, is for the Eternal Coin to develop into some kind of tool or virtual playground where we could encourage communities, but specifically educational communities, to design their own currency, build their own currency, transact with it, and see if they could create some kind of eternal coin, what form that would take. Obviously, we would think that could be educative, both in terms of understanding some of the fundamental aspects of money, that it's a unit of account, a store of value, a medium of exchange, those kind of things, but also trying to develop that learning in the context of thinking about value over the long term. So to tie some of that back into what we're talking about this evening, one of the objectives, I think, of this discussion was to consider how best to advise young people about their financial services, their personal finances. Personally, I think there's clearly scope for something that's slightly more formalised in terms of education. But I think from a long finance perspective, one of the key things that we're really trying to drive at is to get business and political leaders to demonstrate real thought leadership in terms of long-term thinking. And I think if we're trying to encourage young people to save for the future, to participate in pension schemes, to aspire to buy a home, it might take them a decade to save up the deposit, and then it's going to take them a quarter of a century to pay it off. And I think if we want young people to aspire to those things and to think for the long term, then we have to demonstrate that the goals that we're asking them to work towards are also reflected in the values of the financial system and the people who are working within it, which could sound incredibly naive and idealistic, but it's probably worth thinking about at any rate. And I think that's really anywhere where long finance is positioned, is it's trying to influence those business and political leaders really to just start to integrate a much more long-term approach and more long-term thinking into that sector, into business and finance. So that's my piece on long finance. I think I'll pass back to Harriet now, and then obviously we can have a bit more of a discussion about it afterwards.
Thank you very much, Stephanie. So lastly, I'd like to introduce Jeanette Leichner, a Senior Managing Director and Co-Head of the Governance, Risk and Regulatory Practice at FTI Consulting. Jeanette's 30-year financial services career spans multiple areas, including investment banking, technology, human resources, operations, just to name a few. She has held senior executive positions at Morgan Stanley, JP Morgan, Nomura and Deutsche. Her final bank corporate role was head of compliance and and operational risk management for EMEA and Asia at Bank of America. Jeanette also provides career coaching for young adults and coaches executives across a range of issues. In November 2012, she published Your Money. I've got my own copy. Everything you need to know about earning, spending and saving. And one of the things Sophie covered at the beginning, one of her points was about education in schools. And I actually would say this would be an excellent Bible for educating kids at school, because I've read it and I wish I'd have had it when Post-its. And I've got post-its, exactly, I have read it. It's fascinating, and I think even if you're not in the 16 to 25-year-old bracket, which I'm not anymore, I would still recommend it. She's also on the editorial panel and educational committee of the board at the CISI. Right. Thank you.
So the introduction's taken most of my 5 minutes that's been allotted. In this 5 minutes, I'm supposed to cover why I ventured into this, which is an interesting question in itself, tie into some of Sophie's issues, because we've worked on a few projects together. And then also a number of you are particularly interested in hearing about the implications of all this financial literacy stuff. What does that mean for the wealth management industry and retail banking? So I'll try to touch on that, but I don't know, 5 minutes I'm going to go over, I already know. Okay, so let me just start with why did I do this? I mean, I wonder, sometimes in life you just do things because you feel you have to, and I'm pleased to see that we're not everybody being in this age range, the 16 to 25-year-old gap that I was looking at, but some people here are parents, and parents have actually found this very useful. But the reason I started writing this is when you get to my age, which I won't tell you what it is, but I wasn't born after 91, you start thinking about what's your legacy, what are you going to do? And my particular skill is I'm able to take complicated things and make them simple. I hear a lot of communication, people saying, oh, the bankers, it's all so complicated, we don't understand the jargon, etc. Well, part of what I was trying to do is demystify some of that. I was trying to be very factual about information, but present information in a way that people could actually absorb it. I also felt I could do it, and the reason for that is during your lifetimes, you go through many phases of economic position, for lack of a better word. My parents were immigrants to the States. We were poor. I mean, really very, very poor. Working in banking, I've been fairly comfortable, but I've had good times and bad times, as everybody does. Everybody's having a bad time right now, as we know. But fairly comfortable. I've also, with my husband, raised 2 children who are now 22 and 24. We're mean, so we are very tough with them, but I'm quite glad that we were. And a lot of people have asked me about how have you made them independent. They both graduated from university this summer, and they're both fully employed. And that wasn't easy, but they are fully employed, and they've moved away from home because financial independence is something that we've talked about from a fairly young age. But I saw the issues they face, and I saw the issues that some of their friends face, and I frankly got a little bit fed up with it because it seemed so unnecessary. I wasn't dealing with people who weren't intelligent or who didn't want to learn, but they didn't know where to turn. They didn't understand the process. So that was another thing I wanted to do. Any of you who are parents know you cannot tell your children anything. So I wrote the book that every parent can give to their child and say, here, it's all here, and know that you can sort of trust that what they need to know is in there, written in a way that they can actually absorb it. So that was the reason for doing it. Interestingly, doing that, despite doing all this other stuff that I do to kind of earn a living, I found out that I have a real passion for this topic. And one of the reasons is that financial literacy, meaning understanding money, if you understand it and can manage it, you're going to have a better life and be healthier. There are stats to prove it. I'm not going to quote the stats, but really there's a direct correlation between feeling out of control with money and illness. So that's really important for people. I also firmly believe, and found from many of the people, that a lot of people were circling in the space. You kind of read stuff as you go along, and then suddenly things kind of start to click, and I started noticing who was in these particular spaces. So CISI, who kindly sponsored the printing of this book, very involved in that. CSFI has been involved. Celia Alabi, I told you I'd call you out, works for PFEG. Fantastic stuff. I spent 2 hours with her a few weeks ago and learned a tremendous amount about what's going on in our schools. And there are many other institutions, my bank being another one. When you read the press, and there's a lot of articles about this topic, you get the impression that nobody's doing anything, and I want to dispel that myth. Is it beautifully orchestrated? Absolutely not. And every time we meet, we talk about how do we kind of connect the dots so that we get to the right outcomes that we're trying to achieve. We're not clear on exactly what the outcome is, though. Let's be very clear about that. And somebody who might be in this audience wrote an interesting email that came in, and it was talking about, is financial literacy the word? And that really resonated with me because financial literacy sounds like this big complicated thing, so we put jargon around it. To me, it's about, can we help people of all ages, starting with the relatively young, or in 1625, where they're really dealing with difficult issues, although that's kind of latter, you have to start earlier. But can we get people to understand money? Can we make them money aware? Can we make them understand what are their behaviors and what influences how they spend money, save money, or earn money? So looking at that holistically and making sure they understand that. So each of us, when we go to buy something or we take a job, we're thinking, what are the financial implications and what is leading me to that? It's very easy to understand that however you approach money, be it getting a job or saving money or how you spend it every single day, and you do a lot of spending every day before you probably don't even think about it. When you're doing that, everything that came before you is influencing those decisions. So what was your family environment like? I'm in my 50s, and I still have that legacy of what my parents told me when I was a young kid. So your parents influenced you, your colleagues at work, people that you grew up with, all of that influences the decisions that you actually make. So understanding them is really important. I was very pleased at a panel I went to recently that people talked about the behaviors. I thought they were going to talk about the way we teach people exactly, or what's included in the curriculum, but it was much more around this behavioral work, which I think is really important. But I'm sure you guys will have views, so we'll touch on those a bit later. My approach, and I gave a TED Talk recently around helping people understand money, is they need to take what they learn in school and what they've learned in the environment, and then go into any money decision with confidence that they can make the right decision. What gives them the confidence? It's not battering their brain full of information like how do you price the derivative, which somebody said in the press the other day. It's getting them to understand that they understand their perspective they bring to a money decision, and then know that all this stuff that they learn in school about how to research, you know, how to find out about X, Y, Z, they use the research tools and technology that have at hand to unpick whatever the topic is. If you can unpick, you know, the Revolutionary War or World War I, you can definitely unpick this financial stuff. So I think it's giving people the confidence, and that starts with getting them educated about money stuff at a very young age. That's what I think that what it is that we're really trying to solve. I'm now going to quickly turn, because I'm well over, to financial services, wealth management. Okay, anybody in this room knows that financial services is a very difficult situation at this moment in time. None more so than the retail industry. And the retail banking industry has an issue around current accounts. Who pays for current accounts? We all do one way or another, but we don't know what we're paying for. We don't know what it costs. Big issue that the OFT, some of you will have read, commented on that this week. But make no mistake, banks are in the business of making money. It's hard to make money as a bank. We're making it harder. So it's a real state of flux. What's their responsibility? Their responsibility, as well as the regulator's responsibility, which we must not forget about, is to educate the public. It's one of the statutory requirements under FSMA. So how we suddenly ended up thinking, what is this all about? The regulators have a responsibility, as do banks. Banks are doing work in this space. Some of you may have seen on January 5th an article in the Weekend FT that was talking about the three major retail banking institutions here, and they're sending people into the schools to teach. They're not the only ones. I've spent my whole career in banking, and I know plenty of people who've done that. The unfortunate thing, going back to financial literacy, is instead of the article applauding these organizations for investing time and money in this process, they went into a tailspin about, oh my gosh, how can we have the people who misled retail customers into the PPI space or misled customers into Wonga, et cetera, oh my gosh, how can they possibly be teaching people about money? Well, I would suggest that there's a handful of people who maybe didn't do the right things over the course of the financial crisis, but there are a lot of people who are trying to do their piece to do the right thing to address this issue, and that shouldn't be forgotten. Wealth managers, even in a worse space, there was a lot of regulation that came in this year around the retail distribution review, which changed the way that you charge people for the advice that you give them. The end result of this, my personal belief is it will make it very difficult for people who don't have a substantial amount of assets to invest, because it's very expensive to provide investment management services for individuals. What they're doing is saying, if you can't give us X amount of money, and it depends on institution, I'm afraid we can't really support you anymore. That's going to put more impetus and responsibility on individuals than they even have now to actually make their own decisions around investment. So there's a lot of work to be done for that reason as well, to help people understand money. And I know a lot of the wealth managers actually do a lot of education, but particularly for their people and the children of their people who are at the much higher end of the economic spectrum than many of us. So two parts of industry that are really having a tough time, that are trying to do the bits for this. Can they do more? Absolutely, but they are making efforts, and that I better stop or I'll be in trouble.
Brilliant. Thank you very much. Well, can we all please thank the speakers? Just before we start the Q&A session, Alex Cannon from the CISI would just like to say a few words.
Thank you. I just wanted really, as a representative of the CISI, who have arranged this event, to say thank you all for coming along and taking some time out this evening to come along and listen to our speakers. I just wanted to remind you really about, from a CISI perspective, many of you will be studying our qualifications, just about the eligibility for upgrade to your membership that happens at the point where you graduate, where you complete your qualifications, and that we have a number of levels of membership. We're showing on the screen there the ACSI and MCSI levels of membership, which you'll be entitled to once you've depending on the level of qualification you've completed. Once you then become a full member of the Institute, as some of you may already have experienced as students, you have access to a wealth of different types of benefits, primarily CPD events similar to these, are completely free to you all. We also have large discounts for our CISI courses, and we have 7 professional interest forums which are extremely popular and are a great opportunity to network and share common concerns, problems and interests with like-minded individuals. So please take some time to either catch up with myself after this event and speak about how you can upgrade your membership. And indeed, we've got Alex Priddle from our qualifications department sitting over in the corner with me as well to talk about, after this event, anything about any wealth management qualifications or any further qualifications you might be interested in with the Institute. So thanks again for coming along today. We have got some refreshments once we've gone through the Q&A session. They are on the 3rd floor, I've been told to tell you. So come out here, follow the directions and we'll direct you to the 3rd floor. We've now got a question and answer session, so thank you for your time.
Fantastic. Thank you. Do we need
Someone
is someone
take that.
Helen? We've got someone doing the mic. Brilliant. I think just because of the recording, we need to make sure that we can all hear you. So, have we got any questions? And fantastic, at the front here, please. If I could ask you to introduce yourself and thank you.
Good evening, everyone. My name is Freddie Ewer, and primarily I work as an investment consultant for Reddington, but also I run a financial literacy and entrepreneurship mentoring program called Red Start with my colleague Johnny. So we're here kind of with both hats on, so to speak. My first question is to Jeanette, and having written your book, do you think the responsibility for teaching financial literacy lies with parents? And my experience is that some parents don't have that knowledge or the appetite to learn it and teach it to their kids.
The responsibility, this is going to sound awful, but responsibility, I believe, rests with everybody who has an influence on another individual. Parents come in all shapes and sizes and capabilities around many things. There's some parents who would be woefully inadequately prepared to talk about finances. It's an interesting socio-economic issue because my lunch with Celia, when I talked about socioeconomic classes, she pointed out to me that in some cases the people with the least money and the families with the least money are actually doing a much better job of teaching their children about money and how to manage it than the more wealthy people. There was a study done by Barclays Wealth Management, and this was quite shocking. They found that 25% of the people who had more than 10 million pounds of assets wished they could do a better job managing their money. So this isn't a money issue, this is about how do you teach people. So I believe parents have a role. I think in education we have a role. Probably the only industry that's getting more bashed around at the moment than the financial services industry is the education industry. Lots of changes going on there, so it makes it hard. There's every reason to believe there's some teachers who are less well prepared to teach whatever we want to call it, about money to people. I mean, I wrote this book, and I had to do a little research sometimes, so I didn't have all the answers either. So I think everybody has to play a part, but what I will say is ultimately we have to teach people to be individually responsible and help them with that. So, yeah.
Brilliant. Thank you very much. Has anybody else got any questions they'd like to ask?
Hi, I'm Michelle McGarr, I'm a freelance journalist, and well, it's to all of you really. Lots has been said already about pensions. That's kind of the main thing. We're looking long term. Everyone's thinking about pensions, but are pensions the answer for young people? There's lots of hurdles that they have to jump before they even think about retirement. There's home ownership. Even paying off student loans, starting a family, trying to get some emergency fund together even. Do you think that the government needs to do more in other areas other than pensions to help young people sort their finances out?
Stephanie, you covered a bit about pensions. Do you want to?
I think that is a great question. I don't have a very specific answer, but what I like about where that question comes from is that it's not following the status quo, well, let's reform pensions and everyone can have their pension and this time it'll work. Then 10 years down the line we'll tweak it again and this time it'll work. So I think that's exactly the right approach, is just rethinking it entirely, coming outside of this kind of narrow field that we've got ourselves into in terms of thinking this is the right way to do things, and stepping back and absolutely completely rethinking everything around it. I mean, I can't really be any more specific than that, and I certainly don't have any solutions. But I think that's absolutely the right approach to be taking. This system is more or less broken, and it needs a radical overhaul. It doesn't need the next short-term fix.
What worries me as well is that pensions are just, I mean, people actually need this money. You need like short-term access to it. So, for example, if you want to buy a car, for example, you could have that money, but it's locked away for 50 years or so. So I'd like to see a lot more kind of short-term access to it. So like an ISA, for example, that's not the answer, but you can access it much more quickly, and you might even get a better interest rate on it at some points. I
think I'd just like to add in there, pensions is a really difficult issue. I was fortunate that when I was starting my career, if you worked for a company, you got a pension plan. And that was usually a defined benefit, which meant when you retired at XYZ, you get X amount of cash every year. That sounded really good. One of the things that the government did do is help change that, particularly in this country. And of course, there's a lot of tax implications, so countries do those things differently. An interesting topic right now is the forced pension, and that kicks in at a fairly low level of income. And I can understand the intention of that, but I'm not sure it was the right thing to do, because I think early on when people are finishing university or finishing school, because remember the university applications are dropping, they need money for other things just to survive, and I would hate to see somebody putting money into this forced pension and then having to go borrow money sort of short term. That is not appealing to me. Whenever we do anything means tested, that gets terribly complicated, and you need technology to actually do that. What I would say is, however people, so I can't answer the pension thing per se, but I think as a discipline for young people, and for all people actually, myself included, it's useful to start putting money aside quite early. I use the phrase sort of start small and think big. Even if at the end of each week, every kid, they go home and whatever happens to be in their pocket, you take it out and stick it in a jar. Well, that's a way of saving and developing that discipline for quite an early age, to just put something aside for later. And then you go back to, where do you spend your money on, et cetera, et cetera. But I'm afraid I've been around too long to think that the government's going to solve a problem for us.
I think what's very interesting as well is something I read in the book about your student loan, about whether, let's say you get a lump sum from someone who kindly says, this is £10,000, pay off your student loan, although I don't think that'll do it now. And then actually Jeanette asked the question, would it be more sensible to do something else with that money, in terms of, do you want to buy a house at a certain point of time, and do you need to have a mortgage? You need to get your deposit together. So, you need to look at the rates that the student loans are offering, etc., and, what you could get in putting it in an account. But I then looked into what I paid off for my student loan. It gets very complicated. I found it a minefield in terms of trying to work out what rate of interest I was paying. At one point it was inflation +3. Now it's changed again, and it's very hard for me now to work out, have I made the right decision paying off my student loan, or should I have actually have done something else with that money?
And that's understanding interest rates and how that works and what the various options are.
Thank you. There's another question.
Thanks very much, Carl Meekings, Ernst & Young. In a previous life, I did a little bit of work on sort of financial literacy in the UK as well. Now, probably going back to about 1997, so I was about 16 on a canals sort of summer trip at school. My chemistry teacher was moonlighting as a financial advisor gathered all the boys at the front of the canal boat and proceeded to talk to them about how important it was they get a pension as soon as they got a job. Now, I think that probably 95% of that group wanted to throw themselves off the boat and drown themselves. And I was really interested by the finding of Sophie's survey, how many young people actually felt they wanted more financial advice and more coaching. But I wonder whether part of the problem is that, if you're 16, it's great to be told that you need a pension, but frankly, you just don't care. And actually, we could do better things around financial education, financial literacy, by providing coaching at people's different life stages. So, when you decide to buy a house, when you get married, when you have a child. And I know there are some sort of moves in that direction, and certainly, there's some material out there, either through the government or various banks will provide some material. But I just wonder if there's more that we can do in that space.
I'm not sure if I completely agree with that, Carl, just because I think that people like you and sort of wealth managers quite often underestimate how much young people actually know. I mean, I think Celia will probably know about this as well. I mean, we were at one of our own talks back in November, and a chap who was speaking said that about quite a lot of young people who were sort of 10 and 11 had never actually seen like a note or something, a £50 note. And
said that.
oh, was it? Sorry.
And I said that they often arrive at school at the age of 5, never having
11.
met money. That's quite common, that they've never actually met the tangible money because their parents are using credit and debit cards a lot, doing a lot of online shopping, so they actually haven't got a concept of money or understanding money right at that very young age.
Yeah, well, that's right. And I was also reading another article today that said that something like 1 in 3 10-year-olds have used their parents' credit card to buy something, and yet only about 27% have sort of any idea about the basic concept of debt and the fact that you've got to pay it back. So I think that before we start looking at life stages, I think the Money Advice Service does quite a lot on this, like that campaign. I think you've got to kind of look at the basic level and make sure that people understand about compound interest and just things like that, really. I mean, a few people in my survey sort of said that they had a very hazy sort of understanding of what pensions were to start with. Like, they pay X and Y, and anyway, does anyone else want to add anything to that, really?
Well, I think Money Advice Service does do events-driven education, and they have a very useful website. The work that PFEG does is done by different age group, less what you described, but more by age group. And my bank, run by Lily Penna, also does education for certain age groups. But I think there is room for event-driven. The things I worry about now are different from things that I worried about when I was in my 30s, which was different. I would have been on the front of the boat saying, I don't think so, I don't care, I have to say. So there are certain times of life where you think about different things. And so, for example, when I did this book, deciding on the age range is, what's the age group where people have the most complicated or the biggest changes in their financial situation and deal with kind of the biggest issues. So that's how I just randomly kind of picked the age range.
Thank you. We'll take that question, please.
Well, I'm Rob Stubbs, Accenture. Following on from that point, I wonder what the role of banks should be in delivering this. I'm thinking about a comment that Martin Wheatley from the FSA made last year along the lines of, when was it that banks stopped advising me and started selling to me? Which is really one of the things that's driven this breakdown of trust between customers and banks, in the sense that you don't want to walk into a branch because you don't want to get sold. And yet there is the space, the environment where it strikes me so much of this good financial education should be taking place. Because I don't get Jeanette, to your point, notwithstanding the fact that bankers are meeting resistance when they go to school, terrible bankers. These are the guys who should be helping people, not just Generation Y, but Generation X and above, on how to use their money? Because it strikes me we're almost in this situation of perfect storm where we've got post-financial crisis, you've got economic hardship, you've got, particularly in Gen Y, a group who are very self-directed. They're used to going out and finding the right information for themselves, and with no bankers there, so you give them that advice. Plus, you've got at least one bank withdrawing from branch bases at last couple of weeks. Sorry, I'm obviously rambling, but there's something there about what should the banks be doing. It doesn't strike me that just sending some guys into schools and talking about money is enough. There needs to be something more. I know Sophie mentioned parliamentary reporting to this. So I'll use around that. What do you think about the session of banks?
I think, first of all, there needs to be a sort of consensus as to, I mean, there isn't enough uniform stuff between different banks. I mean, Barclays might say one thing or might offer a different account, and it's not that easy to compare like different accounts and different savings accounts. And I think before we can do anything on that, we need to sort of get something in place, like make it much easier to sort of look at a different account and see what's better. And then once that sort of trust is in place, then we can start looking further and kind of like making a bank a place to kind of where you can learn stuff. But I don't know if anyone else has got anything to add to that. But I think we're quite a long way off doing that at the moment. But
I think it's difficult. If I go back to my point, back in the old days when we had banks, I don't remember getting a lot of advice from my bank. Nobody said this is how a bank account works, et cetera. So I think when we say now they should do it, I think we have to look back as what did banks do? That wasn't their job. I don't know who did. I guess parents did. I'm not sure who did it. I don't remember my parents doing that. So do they have a role to play? Yes. But I think you have to look at the whole spectrum and think about what is the problem we're solving for and what role can each group play in it. So I think parents have a responsibility, extended family has a responsibility, education has a responsibility, financial institutions have a responsibility. And so it might be that everyone's responsible for so therefore nobody takes responsibility. Or everybody, what I see now is everybody's trying to do their bit, which is good in the sense that clearly everybody recognizes we need to do more in this space. But I think, like in many things, we're circling around it and everybody's with the best will in the world, struggling to figure out what is their niche and how does it fit into the whole. So I do hope that in the near future, all of the vested interest groups will come together and say, how do we pull this together in a way that we're giving people what they need? So the people who have parents who can't support them in this educational way are getting it from somewhere else. I happen to be a strong believer in the education system, any education system. I wasn't educated here, I did it in the US. But you have a captive audience. You know, there's a certain age where kids are supposed to turn up at school. Now, they don't all, but to me, having a captive audience is something we need to harness and do something with. So I think there's kind of this remedial effort that the banks, et cetera, are doing, but I personally believe it starts, with the family and then the school.
I think we're going to take one more question, and then we can carry on the debate over drinks. Maybe the lady at the end.
Hi.
Oh,
Hi.
sorry.
I'm Ian Bain. I write the Young Money blog, which I believe is the leading blog about personal finance for young people in Britain at the moment. And I wanted to ask about the role of the media in this, because you mentioned about articles which talk about personal finance education schemes and how perhaps they don't do justice to the full scale of work at the moment. And I think maybe one of the problems is that newspapers are being read by older generations. They're not being read by the 18 to 25-year-old bracket. And that's a problem for newspapers as much as it is for the 18 to 25-year-olds. But maybe one way that we can engage young people more is by going through the type of media that they actually like, such as radio. I was recently on Radio 1 on their Sunday surgery, and the response was incredible. People really want to talk about these issues, but they struggle to find forums that they feel comfortable with. And I think things like radio and TV, this is what, as you mentioned, has the potential to have a captive audience. So I wondered whether any of you had considered this, And my second point is about payday loans, because Sophie said that 3% of young people taking out payday loan, quite a low figure, but I suspect that's rising a lot, and I think it's probably one of the biggest threats to young people's financial safety, really, considering that they've created, payday loans have created this need for debt where it didn't have to be. And I wondered what the panel thought about that and whether they think it is a threat that really needs to be addressed.
I'll take payday loans. The threat isn't the payday loans, the threat, and I know quite a few people, I was surprised at the 3% because I seem to collect horror stories about it, but also some success stories. If you understand what a payday loan is when you take it out, and if you're in control of your money and you know you can pay it off when it comes due the first time, that is a great way to borrow money. That'll make me terribly unpopular here, perhaps, but that really is a great way to borrow money. It's much faster and cheaper than going to your local bank and going into overdraft. And it's much better than the alternative sources where people look, which is usually not with savory characters. One of the things I suggest people do is if you want to borrow money and your parents or a relation or a friend can lend it to you and you know you can pay it back, you can also do a deal with them. If I'm going to get 0% interest on my current account and somebody I know comes to me and says, you know what, I need to borrow £200 to get me through now until payday and I'll pay you 4% interest, I'll take that trade. So I feel quite strongly about this, obviously. I don't like what I'm seeing in the press about payday loans, that it's all bad. Because there was one article which explained the difference between a payday loan cost, really, and the cost of a bank, really. And that really told the answer. But that wasn't picked up on as much as I would have liked to see it be picked up on. Which takes me to the media issue. Social media is the way to go. I had to have a Twitter account because I had this. I mean, it's difficult, very, very difficult. But that is the way to get to young people. And back to the banks. Banks are trying to help people with this. I can't mention banks here, specific banks, but a number of them, instead of you having to figure out what all your money goes to, it will classify. You can put stuff in when you draw money off your account or whatever, and they'll kind of give you a statement of where your money went in the current month. They'll send you text messages when you're going to hit your, zero balance or go into overdraft. That's helpful stuff. We used to have to wait until we got the big bill, and then kind of clean up the mess afterwards. So I think social media is being used by institutions more and more. They're very aware of it. All the major banks have committees working on how do we get to the young people? How do we make it easier for them to bank?
I know I had to try and find my checkbook last night, which was, I was unsuccessful actually, because everything I do is online. Yeah. But I had to get my driving license renewed, and they asked for a check, and I just thought, I have no idea where my checkbook is. So I think that's a prime example where I know quite quickly how to log on online, and I've got my little key card, but I wouldn't be able to write out a check anymore.
I think I would just pick up again on the payday loans thing. I don't know enough about them, not as much as Jeanette at all, but I'm not sure they've created the need for debt. They're servicing a situation where people are constantly in debt, and young people are finding themselves in situations where they need to have access to this money. So I don't think they're the cause of the problem. They've arisen because there is an issue around debt. So I would suggest that it's maybe more that way around. I don't advocate them, and I don't really know anything about them, but I steer well clear personally. I think on the media it's a very interesting point, and maybe goes to the media in general about what kind of message they send young people, not just about finance, but about everything, about life, about what kind of values you should be holding, what you should be aspiring to. And I think it would be slightly awkward to sort of come in with some very kind of, long-term, because that's what I think is important in this context, approach to finance when they're telling you, that fashion is literally week to week, and you've got all of these other kind of priorities that change kind of, on such a short timescale. So I think the role of the media is very important, and yes, about the medium too, so how you actually get through. And I'm sure that Radio 1 was probably a brilliant a brilliant forum, like for that directness. But I think it goes wider than that, really. It's more about the media's attitude in general and what they're kind of feeding. Because finance is, you know, it underpins everything. It's not really just about, do I understand my tax return? Can I make my mortgage payments? It's about, how do I live my life? What's important to me? What are my values? And so I think that kind of plays into it as well.
Sorry, I know that I said that was the last question, but I was wondering if I could ask Celia to ask her question.
Well,
Just
that feels really cheeky. But I actually wasn't going to ask the question. I was going to add something to the debate, but since the debate is now over, maybe I shouldn't add it. Except that at PFED, which is where I work, and we are committed to financial education in school, there is a responsibility that parents have to financial education. Of course there is. But we don't leave a lot of education to parents. We actually have a kind of contract in this country which says, yep, we can do maths in school, yeah, that's fine. We can teach them English, we teach them how to read in school. Most children learn how to read in school, they don't learn how to read at home. And these things are contracted out to teachers, and my feeling is that financial education should not be ignored by parents, but should be contracted out to the education system, because actually if they are going to learn about all the sorts of things we've talked about today, avoiding risk or accepting risk and taking risk. You know, is gambling right? Is it wrong? Are payday loans right? Are they wrong? All those kinds of things that they need to grow up and actually think about. And as I was saying earlier, you know, children are starting school at the age of 5 without having met money, a lot of them. And that's the fault of the parents. So I really don't think that we can say that the parents are the right people necessarily to do the entire job. So I think there is a body of knowledge that children should learn at school, and that knowledge should be simple when they're very young and get more complicated as they get older to the age of 16 and so on. But I actually think that there are skills and attitudes that go along with that teachers should be teaching too. Because at the end of the day, what we want them to do is to have left school with enough confidence to manage their own money, to make decisions about money, to know when they're being ripped off by people, whether that's bankers or whether that's their friend, to resist peer pressure. All those sorts of things are really important. So that's what I wanted to add to the debate. Sorry.
Thank you very much.
No questions.
Thank you. I think we've had some fantastic questions there, and as I said, hopefully they'll continue on the third floor. Thank you very much.